basics of swing trading. All right, we get into the juicy juice. You know what I'm saying? Because investing is one thing. Investing is as important as swing trading and as important as everything else. Everything is important and has its place in this rule. Okay? Investing is the long term. We want to buy these companies. We have ownership. It's a good feeling. I own this company. I know when I go spend money with Apple, I'm going to make that money back on the back end. And when you get to a point to where the growth of the company and the dividend that you get from the company actually pays you more than what you pay that company on the year. So if I make $100,000 from Apple, but all I pay as Apple is $1,000, I feel real good about myself. You know what I'm saying? I'm doing good. I'm living the way I'm supposed to live life. I'm living abundantly at that point. So here we are, day 4, basics of swing trading, right? Now, swing trading, we're using our skills to get money out the market. We are strictly extracting money out of the market. It's simple. That's all we're doing. Swing trading is a short to medium term trading strategy where traders aim to capitalize on price swings or trends in the market. This typically involves holding stocks for a few days to several weeks, unlike day trading, which involves holding positions for a few hours or minutes. Okay. The goal is to profit from price movements within an established trend or market cycle. So, short to medium term means anywhere from a day to a year, basically. Anything kind of over like a year is called position trading, which means you're just building up a position at a base and then you're trading it and waiting for the market to pop up. But swing trading is more sniper like. So you're looking for exact price and we're going to sell at the exact price or multiple prices. So that's all swing trading is. So day trading involves holding a position for a few hours or minutes. So day trading is a little different. Day trading, we're actually trading within that day. So that's people, you can see people on TikTok and Instagram and all them little charts up and all that. And I made $1 million in a day. Yeah, right, buddy. Anyway, but just don't fall for that. You gotta make sure that people actually do day trade, but you gotta make sure people have verified broker statements. You want to actually see their broker statements and see their accounts. You don't want to go off of a little screenshot because anybody can luckily make money. When you see that tax return, that tax form, you know you can trust that person, right? Okay. The goal is to profit from price movements within an established trend or market cycle. So, all we're doing is looking for price movements. In an uptrend, if we're trading long, we want to be in the uptrend. We do not want to be trading long. If price is moving down, we should not be buying price. But if price is moving up, we should buy price. You get what I'm saying? So we just got to make sure we're choosing the right direction with that. All right, key concepts. You have trends and patterns. Swing traders identify up or down and specific patterns, support and resistance, moving averages, time to entries and exits. All right. So let's show y'all that really quickly. Right? So, oopsie daisies. All right. So support and resistance. Remember earlier, and if you didn't see day 3, I need y'all to go see day 3 because we got this sniper support and resistance, and that was just on some lucky whim stuff. So that was amazing. But got support and resistance right here. This is support. So say for instance, like the good level I got, if we put our line right here, price had came down and it bounced and then it got back up, right? So we have candlesticks, bars, and wicks, right? This candlestick shows you the open, the close of the day. So if price open here at, let's see, 217.55, right? And then price closed here at about 220.61. At the beginning of the day, price open here and it closed here because the market opens and closes every day. It's like a store, basically, right? The wick, which is this line that's coming out of it, is where price was. So price came as high as 222.75 within a day, but it didn't close there. It actually came back down and closed here, right? So when we see wicks, we say, okay, price came here, but it didn't stay here and it wicked off it. So this is a strong level. So this is a good level to put a support and resistance line there, right? As you can see, it touched here, it touched there. It sought support. So it either got supported by it or resisted. So when it came up and it kind of resisted a little bit, then it came on top, it started to get support. And it fell all the way through. So it all the way invalidated that. Came up a little bit, came up in this area, and it dropped. Now, I don't like using support and resistance levels like this, but this is a way you can use it. I actually do something a little different when I'm looking at entries, exits, and profit targets. But this is a way that people use support and resistance, right? So I'm just teaching y'all this because if y'all like this and y'all want to use it this way, y'all have the tools to do it. Simple as that, all right? Okay. Okay, we got here technical analysis. Swing traders rely heavily on charts, technical indicators like MACD, RSI, and moving averages and patterns, head and shoulders, candlestick patterns to make decisions. Okay, so there's a lot of different things you put on a chart like MACD to RSI. So I can show y'all these really quickly. We're gonna quickly pull these up for y'all. Let's see RSI. All right, relative strength index. So usually what this is supposed to show you, and I don't like this indicator. I used to use this indicator when I first started, but I just don't like it no more. Okay, usually when a price gets over this 70 line, they say that the stock is usually overbought, right? And sometimes it works, right? I would say it works sometimes, but it's not accurate, not like pinpoint accurate. I like when I see something and I need to work 100%. I need it to be no discretionary. Like, should I take up some here? Should I not? I don't want to think like that, right? And there's times where it'll pop up like here, but it doesn't go oversold, so you don't even get a chance to sell, and then you come take a loss when you could have took some profit by using a different method. That's why I don't like it. I need it to work all the way, and when it doesn't work, I need to know why. So, like this, for instance, like I just would have lost, and I just would have been SOL. You know what I'm saying? If you know what that means, I would have been SOL. So, we don't want to be SOL. We want to be always, we want to always have our luck. So, then here, you got a drop here. It went oversold, so this would have been a good time to buy. And look, oh, do you know? Perfect time to buy. So we bought here, and if we held it to the next time we was to sell, which would have been here, we would have actually not made that much profit. Because if you look, it peaked up right here, so we would have sold here. Yeah, we made some good money, but we missed out on this whole run up. So I was like, bro, how do I catch the whole run up to the best of my ability? Now I'm not going to buy here and exactly sell here. That usually rarely ever happens. If it does, it's usually luck. That's just not happening in trading. But I'd rather slowly take profits as I go up to increase my risk to reward ratio. So I was like, how do I do that? And with our side, we cannot do that. Now, that is an option, right? That's a good beginner indicator, especially if you want to just start learning how to buy and sell stocks when you want. It's not a bad, if you buy good companies at low RSI, so it's a good time to buy here. Investing, good time to buy. I wouldn't use it for trading at all, but it's a good time to buy here, good time to buy here. You could have sold here, whatever. I just don't like it. I don't like it. I don't like it at all. So we're just going to get out of here. We don't like that. All right. Now we have the MACD. Like I said, when I'm a beginner trader and investor and all, I used to use all of these things thinking I'm about to get rich. Doesn't work like that because a lot of these things give you false signals. And if I want to get a false signal, I want to get the right false signal. I need the false signal to make sense on why it's a false signal, right? All right. So usually with the MACD, when you see it's green, that usually means to buy. When it turns red, that means to sell. Green means to buy. Red means to sell, etc. So usually, like I said, most of these indicators, they kind of work for the most part, right? So like here, you bought here. Do I have the up and down tool? Let's find the up and down tool right quick. So we can be a little more. All right. Let's see. Let's favorite. We're just going to favorite it. All right. So they said to buy right here. So we bought here. And then they said to sell all the way here. All right, so that would have been a good trade. You would have made some money. You're happy. Oh my God, I'm about to be rich. I learned the stock market stuff. No, it don't work like that, buddy. It don't work like that, my boy. But I mean, in theory, you would have made money there. Now let's look at it again. They were just solely focusing on buys. Then they told us to buy here again, and then they told us to sell the next day. Okay, well, we didn't lose that much money. We not tripping off that like that. It's whatever, say. Wins and losses. We bought here, and then we sold here. Okay, so we basically broke even. That's not bad, Zay. Come on, Zay. What you talking about, Zay? We bought here, and then we sold here. Now, did we win more or lose more trades? So far, we've either broke even or lost trades, right? You might be like, all right, Zay, that's not bad. It's still kind of there. All right, fine. Now, we missed this whole rundown. You could have sold here and made some money. Do whatever you want, The world is yours, right? Then we buy here. All right? And then we sell here. So, as you can see, it's not as consistent. The market is moving down, and we're buying and selling, but we're not making no profit, right? So, that's where, and if we clear all these charts, we got to clear these charts. Moving these non-charts. So, as you can see, it doesn't work how you want it to work. Now, you can create certain rules. I'll only sell after we get a red signal above the line, or I'll only buy if we get above the zero line. The zero line is this line right here. So there's a zero line on the MACD. You might not be able to see it good, but it's here, right? Where that red line at, and I can make that white to make it better for y'all. The white is a zero line. So usually they say if we're below the zero line, we're in the downtrend. If we're above, we could be in the uptrend, etc. So it's just ways to look at it. Now, if you would have bought at the green line below the zero line, that would have been a good undersold. So you kind of use like the RSI. If it's below the zero line, it's oversold, and it's above is overbought. So if you bought green under there, you could actually, if you invested green under here, you would have actually made a good money on your investment. So that's a way you can also look at it. Same with here. That would have bought it kind of here. It's not the best price, but you know it's still better over the long term though. That's why investing is over the long term, because even if you bought it here, you still made all of this money. So we bought it here, and the return, let's just say, from here to here, 36% return. So at the end of the day, you still made some good money. So I mean, it just depends on how you want to use it. I want to use it for trading. I need more precise and more precision, but you know this is a good. If you want to use it for investing, along with the RSI, I would use those more as investing tools and not trading tools. When you're using trading, you got to be super duper precise, and MACD and RSI is not going to cut it for that. Okay, so that is that. All right, 4. Let's get into it. Well, we just getting started, baby. How swing traders enter and exit trades. All right. So we got entry points. Swing traders look for a price pullback in an uptrend or price rallies in the downtrend. They may enter the trade when the market price bounces off support or breaks above resistance. So I was showing y'all that in I believe day 3, where we had a pullback to that limit order. So when I was showing y'all the limit order, how we pull back, that basically is like an entry point, right? And exit points, swing traders typically sell when they see signs of trend reversal or when their profit target is reached. They might also use stop loss orders to limit potential losses. So remember, I was also showing y'all that swing low. So like right here, give y'all a quick example. Swing low is here, right? So we could be like, all right, the market shouldn't get lower than here. If we bought here, the market shouldn't get lower here. So we'll put our stop loss here. We'll stop completely out the trade if it comes down because our analysis is wrong. Usually a pullback, so say we was here and then it pulled back to this limit order on this trade. We would have got in here and we would have rolled it up, and then our profit target would have been here. So that's all that is. Actually a really beautiful trade. That's gorgeous. Actually, I ain't gonna lie. This is a gorgeous trade. Look, just take it in for a second. That's gorgeous. All right. So boom, it's gonna move those 3 drawings. That's beautiful. All right. Let's get into it. Get back into it. Oh my God, my mouse dropped. I got a pet mouse in here, y'all. My pet mouse is moving my mouse. I'm playing. All right. Risk management and swing trading. So I was talking to you about stop loss orders. A stop loss is a predetermined price at which a trade will automatically close if the market moves against a trader. It helps limit losses. So, in the episode or the day where we talked about risk, in trading, you have to be very precise about your risk because you do not want to lose all of your money when you're trading. You don't want to do it. You will be crying helpless. You'll be hurting. So that's why we put stop losses in place. Position sizing. Traders decide how much capital to risk on each trade, often risking no more than 1 or 2% of their total portfolio per trade. Now, people go about risk differently. It depends on how you want to trade. Usually 1 to 2% is a good starter kit. Now, there's people that have different strategies and use different ways to trade, and people flip small accounts and use higher percentages or whatever, or people want to play it safe and use lower percentages. This is just a benchmark when it comes to trading. So risking 1 to 2% is at the maximum. If you have $1 million account, you want to only lose $20,000 on that trade. Right, so that's all it is. But you want your reward to be as much. If you can risk 20,000 and make $1 million, somebody go hire you instantly. They go recruit you before you can even blink. So just keep that in mind. Okay, risk to reward ratios. Successful swing traders maintain a favorable risk to reward ratio, risking $1 to potentially gain 2 or more. So that's a 1 to 2 risk to reward. So if I'm risking $1 to make 2, that's a 1 to 2, which is a real good trade. If I'm risking 1 to 5, is amazing. Usually, I aim for 1 to 5 on my day trades, and I'm looking to get as much as possible on my swing trades because swing trades can keep running. So, if you can get like a 1 to 11, or like a 1 to 20, like you really can get good on like. Okay, I'm gonna give y'all an example right quick. I even went to the next page. I'm too excited. Let me show you something. Okay. Let's put a simple EMA because I ain't show y'all simple moving averages yet. So we're gonna put him up on there. All right, this is insane. No, we're not using all of them at all. We're gonna actually get rid of all of these except for one. So I'm gonna make this very simple for y'all. Trading is really easy, dog. Like trading is so easy. It's really easy. 200, 200, 200. It's simple. I'm sorry, simple. Simple is easy. I'm sorry. Okay, check this out, right? Okay, people don't have the patience to wait for like a 200-day cross. They don't have the patience for it, but that's where you can make the most money. Okay, let's come back to where it's a little bit more cleaner, right? It's a little clean. We can even look up there too. I don't care. I ain't scared of nothing. All right, boom. If we was the only way for a break or retest of the 200, so the 200 is like the most standard EMA of all time. It's just the standard, right? It's the most standard EMA. Now, swing traders, back then people used to swing trade shares, right? So I'm swing trading shares. Every time I got above the 200, I'm looking long, right? Because that means it's bullish. If you see a stock or something over the 200, it's bullish. It's looking good. If it's under, it's bearish and it's looking bad. We're looking for it to go down. So if I either saw a break, which is a break here, but if I wanted to wait for a retest to get a strong entry, I would get in here. I can set my stop loss at this swing low. I can get in here. Now I'm a little bit more aggressive with my stop loss, so I would have put my stop loss right in there. I'm super aggressive with my stop loss. And as you can see, we didn't hit. I like to do this with my stop loss. I'm super aggressive because I want to risk as little as possible. But look, I risked that much, right? I only risked this much. Let me change the color of this. Let me change the color of something because I don't want y'all to be looking at a bunch of slime on the screen. So let's look at this. Change this out to like red. I usually have it red anyways. So we entered here on the close. We got our risk here. So we only risk in whatever. I'm gonna put the risk to reward up in a second. But look at all of this that we can gain. So we could have gained all the way up here and it came down and closed below. But if it's holding that 200, it can really stay above for a long time like here. So it stayed above for a long time. So just imagine even if we was trailing our stop and say after a gap down we close out. So we close out the gap down. So we didn't get the whole trade. I'm not even trying to make it seem like we got the whole trade. The gap down, we scared. We don't like that gap down. So we get out of it after that. So we're gonna pull up our risk to reward parameters here. We got in here. All right, let's just do it here. We got in here. Our stop loss is small, right? And oh my god, how far up did that go? That is a 1 to 9, right? A 1 to 9 risk to reward. Just selling here at the gap down, which is that's not a bad, that's a viable strategy, right? It gap down early, that's too much of a gap, we out of there, right? That is a 1 to 9. So if you risked $20,000, you made almost $200,000 off this one trade. Now people think you can't get risk to rewards like that because they want to trade out the 13 EMA, the 21 EMA, which I used to trade. I'm not saying I used to trade that too. When the more patient you can be, the more money you can make. Patience doesn't mean oh, I can't take a trade today or what. Just patient means, can I follow my rules? If I can wait, this entry took me from, let me see, because people can't wait, bro. People want the 20 EMA because they want to make money every day. But would you want to make for sure money? That's high likelihood of happening or not. I'm giving y'all a real game right now. This is a game. I need y'all to take this with y'all for life. We didn't get a long entry since here. So October 27th, then next long entry we got before that was July. So June, July, August, September, that's almost 4 months. We didn't get a whole entry signal, right? But you got these two, but it's just, whatever. Then again, we didn't get another long signal until basically here. So that's basically the whole next year. So can you wait that long to potentially take a trade just for it to lose on you? You know what I'm saying? Like, man, I'm waiting this long and I might just no. Eventually you're gonna win. It's only gonna bounce on this 200 EMA for so long. Now if we pull up the 21 EMA, they could bounce on the 21 EMA the whole year. The whole year could bounce on that. The 21 EMA go follow this all along. So you gonna be getting trade signals all day. We don't want the many trade signals. We want 1 or 2 trade signals, a strong trade signal, we go take the trade. Now you might, and I'm about to give you some more game. I'm sorry, I can't even help myself at this point. Do you want to know why? Even though we closed above here, I didn't take this trade. I took the trade here, right? It's not because I knew it was going to go up. Of course I knew it was going to go up. Of course, obviously. I took this candle and not this candle because it's not a strong candle. And as you can see, why it's not a strong candle? It opened here and it went all the way up, but it rejected the whole candle and closed here. That's not strong. That's still showing selling pressure. So while we buy on the candle, that's showing selling pressure, even though it closed above. This candle did the same thing. This candle was a strong candle, but it was under the 200 MA, which is still a sell. This was the first candle that opened. It came down a little bit, rejected off of the 200 perfectly, and closed up was strong as heck. This is a strong candle. Look what it did next to it. It gapped up. It was so strong that the price gapped. Hold up, I'm sorry. It gapped. What? A whole percentage point. Now, keep in mind, we only get about 10% on average a year from the S&P 500. So if I'm gapping almost 1.6% in one day, that's the power of candlesticks. Almost 2% in one day. So in one day, I almost made a quarter of what the whole year. That's crazy. That's insane. So that's why I got in here. And you could have this was a bad candle too because we had selling pressure here. So this would have been a best entry if you're impatient when you took this entry. But after that, you missed out on the trade unless you got FOMO hopped in, and you would have got lucky for a very long time. So that's pretty much how this works. That's how this works. Now, people don't have the patience for that, but if you do, you can make a significant amount of money. And the last piece of game, because I still can't help myself, take it to the 1 minute chart. Let me see. Look at this. You get in here and you ride it all the way up here. How can you not make money with that? That is so simple. You don't need 15 indicators, bro. You just need that. Get in and hold it for dear life. And you never get stopped out. You just hold it. All you gotta do is have parameters. Have your profit targets, have your parameters. Bro, that's it, bro. That's all you need to trade, bro. That's it. You don't need that. You don't need nothing else, bro. You don't need RSI. You don't need MACD. If you watch day 4, you got game. Man, what? Everyone even need to finish day 4. That's it. That's all you need from day 4, bro. I just made you money. Pros and cons of swing trading. Let's get into it right quick. Gotta finish out the segment. I just made y'all game. I just made y'all money. Look, when you get your first million, come on, man. Break me off. You know what I'm saying? Look. All bro needed like, a little 100,000, you know what I'm saying? A little 200,000. Nothing crazy. I don't need all that. A 100 million. You know what I'm saying? Nothing crazy. Like that's easy for y'all. You know what I'm saying? But pros and cons of swing trading. Pros: less time commitment to day trading. Of course, you on day trading you got to be on it. Day trading is a sport. Like day trading, your performance athlete, bro. You got to be working out, eating right. Like day trading gets serious. We serious when we're doing it. Potential for significant profits by capturing large price swings, so that's really good. Can be less stressful compared to day trading as trades aren't as frequent. That's also true. Cons: swing trading requires careful analysis and patience. Yes, you gotta choose the right stock. You gotta choose the right direction. Same with day trading, but swing trading just hurts a little bit more because you're waiting that long, and if your analysis is wrong, then you gotta wait for the next move. So it does require more patience. Day trading just in and out, in and out, in and out. So it's a little bit more fun in that aspect. I'm not gonna lie to you. Even though once you do swing trade right, it's not fun. Either you make money or you don't, and you're not really upset about it when you really start to learn the core of that stuff. But another con: it may be difficult to predict short-term market movements accurate, and that's true. That's why we have systems that do the highest probability we can. So, and you know what's good? When it comes to pros and cons, if you look at the cons and you like, okay, how can I make these cons pros? You will be a successful person in anything you do in life. I ain't gonna lie to you. So it requires careful analysis and patience, but if we make careful analysis and patience, that's a pro. It may be difficult to predict short-term market movements, but if we do high probability setups, then we know that overall we have an edge in the market, so that's a pro. There's still a risk of market fluctuations, and trades can last days or weeks, which may expose you to overnight risk. That is true, but it's the same thing as day trading. The average true range of the day will move up the same as the average range of an intraday. So the 1 day chart and the 1 week chart will still move up. So as long as you do your risk accordingly, yes, overnight risks, of course, but everything has risk. You have overnight risk of dying every day. So I mean, come on now, let's just be real. So let's not be scared of these things. At the end of the day, we're here to learn, get the sauce, make some money. So that was day 4, man. Day 4 was packed. I ain't even know I was gonna give y'all that game, dog. That day 4 packed. Day 4 got that fire in it. Let's hop over to day 5. Let's get into it. See you on the next one.